Good day, guys. Welcome to Trading Arbitrage Opportunities with Calvin Ports. Welcome to episode 35. This is the CAD JPY. We talked about the CAD and how huge the economic divergence between the CAD and the JPY are. The JPY will be pricing in short trades in September, and the CAD is not bullish, it is actually sideways. So because of the cells in the in okay at the moment, the CAD is oversold, and when a currency is, let me show you something. Let me show you something. You know what? Let me go on the page next to and show you what I'm talking about. So when we say a currency is oversold, I'm talking about one currency as in the CAD. I'm not talking about CAD JPY. I'm talking about the CAD alone. The CAD was up like this at this highest level, and it sold for the previous week or month, the previous month or it sold, and when it sells like this, at some point we're expecting a pullback. The pullback in the CAD alone does not necessarily have to come all the way up to where the monthly candle closed. So we are expecting at least a pullback at the 50% feed, and we're expecting the market to move sideways like that. This is what we're expecting in the CAD, but it does not necessarily have to close down here. It can close up here, but the CAD is bearish. It is not bullish. The reason why we are buying the CAD is because the JPY as a separate currency. I'm talking about a separate currency. I'm not talking about CAD JPY. I'm talking about CAD. I'm talking about the JPY alone. The JPY is selling. It was all the way down here selling, and it repositioned itself, meaning that the market has to breathe. The weekly candle or the monthly candle has to give us that pullback, and when it gives us the pullback, it continues with the sells. So because of this pullback and the continuation of sales, this monthly candle will be, or on the JPY, will be pushing the market. This because the JPY is getting weaker and weaker. For us, it will look like the CAD JPY is gaining strength, but only because the JPY is weaker. Even though the CAD is moving sideways, but because of this long move in the JPY getting weaker and weaker, and the CAD moving sideways, here on this picture, it will look to us, for in our eyes, it will look like, let me show you. In our eyes, it will look like the CAD is gaining strength as we are breaking new highs. This is what we're going to be seeing in this economic projection. So because of the huge economic divergence between the two currencies, I talked about on the previous videos, I talked about not expecting the CAD to go all the way down here. The CAD is not yet pricing in anything, but because the JPY is collapsing, it looks like this. But we're looking at a trade that will break the next highs because the JPY will be getting weaker and weaker. So that's the reason the price action or the economic projection that we have for the CAD. Normally, the market reacts when you have two powerful currencies drawn together. We normally have the market coming to the 50% feed, dropping all the way down there, giving us a pullback this big and taking off. So most of the time I draw something like this, but not every currency is able to do that. So here we were pricing in a pullback on the monthly time frame, but this pullback is not giving us that much of a pullback. So it shows us that the market is actually taking off, and we are willing to take this arbitrage opportunity because of the weakness of the JPY, not because the CAD is gaining strength. The CAD is moving sideways. So here I was talking about a major bust. The reason why I talked about a major bust here was I was looking at the, what do we call it? I was looking at the JPY and the interest rates, and let me show you something. I was looking at the volatility index and the S&P 500. So what I use the S&P 500 and the volatility index for is that in a recession, normally this was April 2025. I hope you can see the date down here. In a recession, the S&P 500, or what we call the stock indexes, they normally take off before the end, before the recession even ends. This takeoff, the breaking of this high, the when we move into a recession, we expect the stocks to collapse like that. But when they take off like that, they normally take off before the end of a recession. So this signal is telling us that we are moving out of a recession. And with the JPY being a safe haven, it was bullish for the rest of the recession, but it is already collapsing because we are moving towards the end of the recession, and the volatility index continues to tell us that we're actually exiting the recession. And because of these two guys and the stocks behaving well, I'm actually expecting the recession to be over. So we might get a major bust here, not because the CAD is moving out of the recession. The CAD is not ready to exit the recession. It's still in the recession. But because of the weakness in the JPY when the economy gains strength. Remember, the JPY is a safe haven. It normally collapses when the economy is doing well, and it gains when the economy is when the economy is in a recession. So when every stock is collapsing, we everybody wants to buy the JPY. So it's the JPY and the CHF that are doing us well. So the trade that I believe might be taken is here. This is where you can actually see how the JPY, how the CAD is recovering from the recession. It's starting to move sideways. It was collapsing all the way down the CAD, and right now it's starting to move sideways. And because of this sideways move, we are looking forward to exiting the. We're looking forward to exiting the. We're looking forward to exiting the recession. So when we exit the recession, we call it a major bust because we use these kinds of separate currencies to check one currency that is not recovering yet from a recession, and we match that currency with a currency that is already recovering from the recession. So we call it a major bust. This entire move out of this recession is called a major bust. So at the moment, we are not ready to hedge any inflation with the CAD. In fact, if I had to hedge an inflation, I would be taking a trade called pound CAD, GBP CAD. that would be a perfect trade to take for the exiting of the recession because the CAD is not doing well just yet. And as soon as the CAD recovers, I will take profit on the trade, on the pound CAD trade. So that because it's still struggling in the recession, I'll definitely take an advantage of pound CAD. In fact, pound CAD trades are already being priced in. So let me try to let me try to so the pound CAD trades are already being priced in. So at the moment, we might be looking at a pullback that might land on the 50% fib, or yeah, somewhere it will land and take off, breaking the next highs. So this is the trades that we are looking at. But remember, when we trade long term last year, we were looking at the the arbitrage opportunity that we have seen on the hedging of inflation, where the pound was doing well and the CAD was struggling. So holding this hedge inflation trade is is visible for all of us to see that this is how we hedge inflation. We look at a currency that is struggling economically, and we match that currency with a currency that is doing well. So let's check how long this trade took before it gets to the take profit level. This is 29 September. I hope you can see the date down here. This is 29 September, 28 September 2022. This year is 2025, the 28th of August. So this is how long those trades take in a hedge inflation trade. This is the daily time frame, so it's not a lower time frame. It takes a lot of time to get there. So that's how you normally hedge inflation. Those are long-term trades. So here this trade will continue. And on the previous trade that we were taking with the SGDI, or the pound SGD, I was really praying for the market to land, on this trend line. It didn't. The last time it landed was here, and it manipulated the market, and then it came back. This is the spring and this is the test. Those are the things that we normally talk about. And here you can see that the market is not willing to land here, probably because of the economic divergence. And this is one of the trades where you can hedge an inflation of one currency with the inflation from another currency and hold long term. Uh, at the moment, the pound is also not yet moving out of the recession, but it's doing well compared to the other currencies. So it becomes easier for us to look for a struggling currency, a currency that is struggling economically, and using it to hedge the other currency, which is the pound. And we need a positive swap. As soon as the swap changes into the negatives, especially on the last interest rate cut that the pound had given us, we had a trade pound SGD that we were holding on the previous trade. We were talking about the rally, base rally, and the replica. This thing here called the replica repeating itself here. We're talking about that. So this one with the SGD is a negative carry, but it will continue moving higher. And here, as you can see, is the first touch, second touch, third touch. The market collapsed. We are looking to break out of uh, this uh, level. And goodbye, guys. I have to say goodbye. We'll see each other on the next episode. We'll be talking about other currencies.